Sermaye piyasaları, riskler ve fırsatlar konulu paneli açacağız. İsimlerinizi okudukça konuklarımızı podyuma davet etmek istiyorum. I would like to kindly invite the speakers of the second panel up to the podium as I read out the names. Moderasyonu yapmak üzere CNBC'den Sayın Artunç Kocabalkan, Abu Dhabi Menkul Kıymetler Borsası Başkanı Sayın Rashed Al-Baloushi, Amerika Birleşik Devletleri'nden Nasdaq OMX Grup Başkan Yardımcısı Sayın Sandy Meyer Frucher, Almanya Frankfurt Borsası Deutsche Börse Grup'tan Yönetim Kurulu üyesi Sayın Frank Gerstenschlager, İngiltere'den BNP Paribas Gelişen Piyasalar Strateji Başkanı Sayın Marshall Godet, İMKB Başkanı Doktor İbrahim Turhan ve NYSE Başkan Yardımcısı Roland Bellegarde'i bekliyoruz efendim podyuma.
Ladies and gentlemen, it's a great honor for me to host and moderate those speakers, very proud, very profound, very gifted. And we would like to be very specific about the issues. I mean, let's start with the risks and opportunities in a fragile world. What is the fragility? What is the risk? What is the opportunity? I mean, the knowledge is the most important thing. And the cooperation between countries, corporations, stock exchanges, and financial centers are very important. For that reason, I would like to start with the first guest from the Head of Emerging Markets Equities and BNP Paribas, Marshall Godet. Please, sir.
Thank you very much. I'm very happy to be with you this afternoon and to exchange those views on the developments of markets and obviously stock exchanges in particular. The role of stock markets and exchanges is growing rapidly as a consequence of the financial crisis that we had in 2008 and 2009. And it is now clear for everybody that more transparency, more shared rules among the actors, more prices available, more fair value among investment is something that has become a necessity to make sure that we get more trustworthy financial markets that will function better than they did in the past. Obviously, would information related to prices, to volumes, to open positions have been widely available on all asset classes before the crisis, a lot of signals would have been sent to investors and to the financial community on the risks that was embedded by the kind of, let's say, developments of the global economy between 2002 and 2007. As a result, we now have the development of many listed products. And on my field, I can talk about what is happening in the derivative product field with a clear shift from, let's say, OTC products towards listed products. That's very true in the equity space and equity derivative space. That's very true on any asset related to volatility, but that's also now very true on the fixed income side. We all have in mind the kind of efforts that are put in place to have now some listed products on CDS. And we think that this is clearly the right direction for markets into the future. There are many sub-asset classes that are being developed quite rapidly at the moment that were not existing in the past. As we had the development of CDS between, let's say, 1998 and 2008, we now have the development of products related to dividends, for example, that become very interesting. A lot of products on volatility, very complex products to some extent, are also being developed. And it's very important that those developments take place within the community of listed markets in order to make sure that people speak with the same conventions, that they use the same methodologies, that they can rely on prices that are disclosed on a regular basis for investors. So definitely this is a progress and a major change in the way exchanges are working. That's very true for developed market exchanges, but that's also very true for emerging market exchanges, and we see very interesting developments in many of those regions.
Okay. I'll ask you 3 questions right after the speech of other attendants. First, what is the definition of a credible market? Credible market. And also, do you think that it's a good trend taking instruments from OTC to listed markets? And last, do you think that mark-to-market, for example, this bills and bonds market for the countries, is a good way of solving this problem, or stop pricing them, mark-to-market? Okay. And then, Mr. Gerstenschlager, Frank Gerstenschlager, member of the board, Deutsche Börse. Here you are, sir.
Yeah, thank you very much. The goal of this summit here in Istanbul is about talking about challenging, facing the European securities market. And I thought it's quite interesting for you to take one chart of our presentation, which we brought to the Exchange Council of the Frankfurt Stock Exchange. You could probably see here and discuss on you what we think how the future might change, particularly in these equity markets. The major 3 building blocks are typically listing and trading services for securities, the clearing services, and the settlement services. So the entire process chain of buying and selling securities. And the listing and trading, we think that the limited funding capabilities of the banks will it more attractive as well for the real industry to further come back to the capital markets in a way of IPOs, capital increases, and of course of listing of corporate bonds to the capital market. The major change we see on the clearing side is absolutely clearing will be the key for Europe to consolidate more flow into different trading venues and consolidate Europe across the different countries. And settlement, the major change will be the introduction of Target 2 securities will change a lot in the old processes of the different CSDs. So the 4 drivers you could in a chart, the market structure. We believe that the market structure which was introduced with MiFID in 2007, where it was possible to have trading venues, several trading venues trading the same security, we brought competition to the market in Europe. However, the flip side of that coin was the fragmentation. And the fragmentation of liquidity and the fragmentation of this world will happen and stay in Europe. We will see initiatives going up to set up additional trading venues as well in the future. Technology-wise, will that be really the challenge, because this additional fragmentation in the market will drive complexity, which we already have in the trading room, but we will see that complexity as well and risk management in the future. And we will see more of this complexity as well in surveillance and compliance with specific rules. The market, we believe, overall will recover. We see now in Europe, of course, the low volumes. We have the lowest volume since 12 years on the equity market, but we are quite sure that this is not a structural issue. It is a cyclical issue, that these markets come back. And regulatory environment, of course, after MiFID introduced 2007, the new MiFID regulation, MiFID II, which we probably in place 2013-14, will have an impact on other asset classes, which so far not under MiFID regulation for transparency rules. And we will see, as you mentioned already, from EMIR, that the shift from the OTC market come to more light trading venues. Of course, the next years, the financial crisis will not be over. The financial situation will be called now as a driver financial distress. We'll see, of course, a lot of discussion on new regulatory framework for the financial market. If it starts now with short selling rules, it will be further on with financial transaction tax. This will go over high frequency trading and any other additional capital requirements in it. So driver financial distress, regulatory impact. And the customers will change and have already changed as well. The customers, which are called the issuers want more services from the financial industry to finance their business. If it's now own capital as an IPO or listed company, or is it capital which was brought to the company by corporate bonds. The retail investors would like to have more access to several markets, less complexity, and cheaper processes to participate in the overall trading environment. And of course, the institutional investors, they expect excellent execution situation and a very tight and reliable process overall with very low market impact on it. So overall, that will be the drivers for the next 3-4 years on our European security market.
Herr Gerstenschlager, danke sehr. And I'll ask you the impact of this financial crisis regarding the transactions in the Deutsche Börse. And also, is there any protest or something like that from the other companies from Greece and from Italy to be listed in the Deutsche Börse or not? And also, do you think that if central bank, if Istanbul Stock Exchange would like to make a cooperation with you, I mean, as a new financial center, it might be a good idea? What is the risks? What is the opportunity? I'll ask those questions. And Mr. Roland Bellegarde, is correct pronunciation? Bellegarde, sorry. And you are the Executive Vice President of the NYC. And your introductory speech, please.
Okay. So thank you very much. I would like to step back to the title of this panel, which is Capital Markets, Risk and Opportunities. I think it's very important first to look at what are the markets today and recognize the new global realities. First, there is a lot of correlation between the different markets in the world. What do we mean by correlation? It's the tendency of markets to move in tandem. Whatever happens on one side is reflected in other markets quite quickly. So today, when you have a problem in one of the financial zones, be it in the US or in Asia or in Europe, it tends to propagate quite quickly. It means that a financial problem can go cross-border very quickly and very rapidly, and no one can deny that. But at the same time, one of the other global realities we are facing is that emerging markets are opening their financial markets. They're basically trying to have more capital flowing in their country. They're trying to take advantage of this new capital. We're talking about creating a financial center. So it's all the same words about attracting capital, attracting financial activities. So you can hear and see it already. Opportunities about opening markets, risk about propagating crisis. So this landscape basically, as I said, creating advantages and challenges. And what are the real, I would say, starting by the risks. What kind of risk can you face? Referring to a study made by the World Bank in 2010, the number of financial crises, banking crises, over the last 30 years tend to increase. The numbers in the 80s, there were 45 identified major systemic banking crises. In the 90s, 60 major systemic banking crises. In the first half of 2000s, already 35. So the tendencies of an increasing number of banking crises. So the real risk, stated in different words, that regulation is still very local, but the markets are really very global. And regulators and exchanges, and everyone is facing this complexity of having national borders, national regulation, but markets, activities, financial markets being much more global than ever. So definitely there is a need for much better cooperation between the financial institutions, between the regulators, between the authorities. And to be more specific, it's cooperation around disclosure, about transparency. The trend in financial markets is to increase the opacity and to have a fragmentation. The trend should be cooperating around transparency, disclosure for companies, coordinated approach to manage risk in the same way and appreciated the same way across the different zones, but equally harmonization of accounting rules. It's a long-term objective. It's not easy to get there. But if you want to have seamless investor investing in many asset classes across the world, they need to have benchmarks and they need to be able to compare those assets. So finally, if you look at the opportunities, capital markets are basically, it's about connecting those who have some capital who would like to invest with those that can use this capital to turn ideas in businesses and creating growth, economic growth, meaning employment. So that's about the capital markets. What is the role of an exchange? And I like a lot the slide made by Frank. It's exactly about bringing together the investors and the people who are saving and the capital, to bring to the capital to these people to invest and create new opportunities and new businesses. An exchange is, I've heard that this also at the beginning of the presentation, creating and listing and trading products. It's not only about trading products, it's about companies which are looking to be funded, companies which are looking for capital to invest in creating jobs. That's the first priority. So you should not forget that an exchange, it's also servicing the issuers community. And it's as important, if not more important, than just the secondary market, which is about trading, an opportunity to have, to resell your assets. But the priority is to first invest and create jobs and create the funding mechanism for companies. So one of the elements why, as an exchange, we are looking at this evolution of financial markets between risk and opportunities, and is that we are trying to globalize, creating connections, creating partnerships with other exchanges in the world to try to help developing these activities. And obviously for us at the same time benefiting from this. So that's the link for us as an exchange of creating partnerships. We have done it in the past in many parts of the world, in Asia, in the Middle East, and in Europe. And that's the way we can really help the community to fund the companies, and at the same time creating infrastructure that is safe, reliable, transparent, and better for the investors.
Thank you very much, sir. 2 questions. First one, what about this quantitative trading is the most important question, I think. Are we expecting to see any fat finger? For example, if this cooperation and the exchange of knowledges between the stock exchanges are very crucial, but it means that you can take this very local risk to the transfer to other stock exchanges or something like that. And then what is the average rate of new listed companies in the New York Stock Exchange, as we are trying to attract new companies, exactly SMEs, to the Istanbul Stock Exchange? What's your average rate? Skip? Okay. And thanks, Ibrahim Hocam, that he's the host and my teacher, and he transfers his chair to Mr. Meyer.
Hi. My name is Sandy Frucher. I'm vice chairman of NASDAQ OMX. One of the risks of speaking on a panel is that you're way down the line in a panel, and the other speakers, if they were any good, basically have said all that there needs to be said on the subject. So that is my first crisis. The opportunity is to try to say something different. I'm now going to take a real risk and try to translate a joke using a French word which I'll mispronounce and then having it translated into Turkish. So it's often said that one man's poison is another man's poisson, which effectively is someone's crisis and is another person's opportunity. Now, when I looked at this topic, crisis and opportunity in capital markets, I started scratching my head because there are so many different players that it's hard to define who's crisis and who's opportunity. The fact of the matter is that one crisis that exchanges face is that because of products that entered the marketplace that were not on stock exchanges, the world has gone through 4 years of economic turmoil. Actually, it's 6 at this point, years of economic turmoil, as a function of non-regulated products where nobody could manage to calculate the risk at the end of the day, and where no one even internal to the companies understood the magnitude of their risks. And so the opportunity for markets in that regard is to present ourselves to the world for what we are. We are a marketplace where you do have rules, you do have regulation, you do have surveillance, and you have mark to market at the end of every day so you can calculate your risk. Had the world had all of these swaps and other kinds of interesting products listed on exchanges, we'd all be happier today. Now, the risk for a stock exchange is that money, as we have observed, has been flowing from exchanges to not only to other asset classes and opportunities on a global basis. Because the fact of the matter is that stock exchanges are confined to a jurisdiction, as my friend from the New York Stock Exchange pointed out. Money is global, regulation is local. And so it's hard to offer global opportunities to individuals within the narrow geography of your exchange. So that is a crisis that requires a response, an opportunity. One opportunity is globalization. That's what New York has done. That's what NASDAQ has done. Both New York and NASDAQ were monopoly boutiques in their own countries where they sold one product called equities. And they found that when something terrible happened in our marketplace, it was called competition. Oh my goodness. We all of a sudden figured out that we really had to have real technology, real transparency, and in fact, we had to go global. So the opportunity is to go beyond your region. The other thing that people have discovered in the exchange world is that you have a crisis if you're only doing one asset class. So if you look at what's happening here in Turkey, you see that the Turkish government and the exchanges and the community has recognized that exchanges have to be multidimensional, that they have to include multiple asset classes, that it has to have world-class technology to compete, and it has to be able to compete in a world where your technology has a basic foundation in which multiple asset classes can be traded. You have to be able to compete with your technology as new trading modalities develop. When I ran the Philadelphia Stock Exchange, I could not believe the volume that an auctions exchange had to be able to deal with because of the multiple strike points that you had for options. We had to have 10 times the robustness of an equity exchange in terms of compete. So we had to develop world-class technology to deal with that. And then finally, when we cured that problem, oh my goodness, high-frequency technology started to hit the marketplace, and then we had to figure out how we were going to double, triple, quadruple, and keep going on the time, the speed, and on the volume that the exchanges could handle. And yet, high-frequency trading, while occurs to many types of investors, from an exchange point of view, it is troublesome, but on the other hand, it provides significant enough flow that it is also an opportunity. So in this world, crisis does, in fact, create opportunities. In the world of even a monopoly kind of exchange, an exchange that has one market, a significant market, but does not have competition within that market, people think that's called heaven. If you talk to somebody, an older person, now when I say that, we're talking about people in their hundreds, but if you look at somebody who used to trade at the New York Stock Exchange or at NASDAQ, they decry the good old days when everybody had to trade through them. Well, if you're in Turkey, you have a market that is robust, but somebody with capital can take that capital and trade it anywhere in the world. So there is no such thing as a monopoly in the world of finance or in the world of money, because you're not competing strictly against likes. You are competing against real estate in Rio de Janeiro, or I don't know, some sort of exotic kangaroo futures in Australia. The fact of the matter is that people who have money to invest have a world of investment opportunities. And so exchanges have to be able to be creative, they have to be able to be flexible, they have to offer a wide enough range of products, they have to have technology that can deal with it. And when I come to Turkey, I'm really excited to see your market and the process here that is growing to become a world-class market to meet the crisis and to avail themselves of the opportunities.
Thank you, Mr. Meyer. Two questions for you. You were talking about this poison idiom. Do you think that the global crisis is a zero-sum game, or there will be a win-win process? And this is one question. And then, do you think that, for example, Istanbul Stock Exchange is being planned as the mother stock exchange, having the futures and options under the roof of Istanbul Stock Exchange? Do you believe that separate stock markets like Nasdaq, Chicago, and New York, or one roof, just one stock exchange for all the transactions is the better way? And also, you were underlying the importance, the competition between Rio and Istanbul. Do you think that real estate is a bubble all over the world, or a new opportunity to invest?
Now, do you mean real estate as a bubble as
Yeah.
distinct from, say, the tech bubble?
Yeah, exactly.
No, a bubble is a bubble.
Okay. Okay.
An analytical definition.
Okay, I need another definition for the financial center. What is the risk and opportunity to try to be a financial center for Istanbul? Okay?
Okay, can I answer it?
Okay.
The answer is it's a risk not to be. Oh, why not?
You're going to talk about it, and then during the second round.
As my time.
Wait a second. But if I think about it, you may not get as good an answer.
You know, he's my teacher. He's correct. Okay. Let's skip to Rashed Al-Baloushi, Chief Executive of Abu Dhabi Securities Exchange. Okay, Rashed, exactly.
Yeah, it's fine now. Yeah. Bismillah ar-Rahman ar-Rahim. My name is Rashed Al-Baloushi. I am the Chief Executive of Abu Dhabi Securities Exchange. One of the opportunities that we see in the GCC generally and Abu Dhabi specifically is the bond market. As you are all aware of, the bond market is very active nowadays in GCC. As a matter of fact, the first half of 2012, $37.6 billion bond were issued, bond and sukuks were issued in the GCC. Abu Dhabi counted to be the first, or UAE counted to be the first with 8.5 billion. Then Saudi Arabia with 8 billion, and Kuwait with 4.4 billion. So the issuance of sukuk and bond in the GCC is very active, and the expectation is even going higher, because if you look at the study made by Ernst & Young, they're saying the demand, the global demand on sukuk only this year is about $300 billion, while the issued sukuk so far is about 100 billion. So if you look at the supply and demand, we see more people looking for sukuk. I'm talking about sukuk only in this case. And this study is expecting the sukuk market to reach $900 billion by 2017. So you could imagine what does that market mean to us as the GCC and as Abu Dhabi. But if you go down deep, if you look at the problems of the GCC markets, you see the presence or the participation of bonds and sukuk almost zero. They don't exist. Why? Because all of the issuers, they are interested to issue, list, and trade them outside the GCC, mainly in London. So the question comes to us: do we need them? I think yes, we do. But because if you compare between sukuk bonds with the equity market, you always see the correlation is against each other. What does that mean? When the value, when the performance of stocks goes up, that means the performance of the bond normally goes down, and vice versa. When the incentive and when the performance of the stock goes down, we see and we notice, and when you compare the stock exchanges that combine both, we see the performance of the bond and sukuk goes up, which means at the end of the day, the liquidity will stay in that exchange. The liquidity will exist and will make people happy, will make everybody happy. But when it comes to our situation, we see it differently. As a matter of fact, in Abu Dhabi, we've done studies. When we saw the market goes down, suddenly we see the money goes out. And it goes to the banks, because that was the only alternative for that money to go to. So the question that we are trying to, or the GCC has to find an answer to, how to encourage, how to see the markets with two options, at least having sukuk and bond on one hand, as well as the equity on the other hand. That's my observation.
Thank you very much indeed, sir. Do you think that there is a correlation between the oil prices and the sukuk and the bond demand in terms of in the GCC countries? And also, do you think that, for example, Istanbul Stock Exchange and there will be a competition or cooperation in terms of this sukuk and this bond market? Okay. My teacher, please.
Thank you. Good afternoon to everybody. Well, it's my honor and privilege, of course, to be with you today. And I'm going to try to share some of my very humble opinions with you. I am sure there are several people who knows better than I do, but yet I am supposed to talk. I put myself at the last rank, hoping that time may be over until it comes to me, but all in all, we're going to talk. Well, I see the situation in a two-dimensional way, in terms of risks, in terms of fragilities. Because I'm going to talk about risks only, not opportunities, because I am not an entrepreneur. If I was able to see opportunities or to catch opportunities, I would not be here, but rather making money somewhere else. So I am, as an ex-academician, ex-central banker, I can see risks, but unfortunately not too much opportunities.
You're not the risk taker, huh?
Obviously. Well, as I said, it's a two-dimensional space, I think. First of all, there is a conjuncture-related aspect of it in terms of risks and fragilities, and one more structural. When it comes to what is related with the existing circumstances and conjuncture, let me tell you a fun story. It's about three friends living in the same house. One, a German, the second is a British, and the third is an Italian. And they made the organization and specialization of labor. The German is taking care of organization and management. The British, in terms of external relations, and the Italian is taking care of cooking. Well, and they were all happy. They are all happy. And the thing is that the secret formula is if you distribute the tasks accordingly. But if you mix them, for example, if you give the Italian to organization, British cooking, and the German, forgive me, the international relations, it will just be a different story. So here I would like to praise my friend Frank, what he has plotted, what he has put into the screen was really excellent to cover all the details in a very analytical and structured way. The only thing I can add to this quadruple chart is the macro maybe dimension. What is the risk for us? Well, the risk for us is that all governments are running huge deficits, and number one priority for them is to ease the financing of these deficits. And guess what? They are all pushing towards more fixed income government securities, the making up of the market. And not only that, but also regulatory authorities, both domestic level and international level, for the sake of the liquidity, solving the problems related to liquidity, they are also favoring fixed income government securities over other kind of securities. So those dynamics are really not of favor of the equity markets. And of course, stock exchanges are impacted adversely. So this is one issue, but related with the existing circumstances and conjuncture. And the other one, more maybe structural, of course, because of several reasons. All aging society, because of aging society makes the investment horizons shorter, so it's not good for equity investment. And we can see it throughout the allocation of assets, even in more dedicated equity investors like pension funds, compared to what they used to be, 20 years ago. There is a drastic decline in their equity holdings. But there is maybe a more important issue, which is that, again, it is related with the very nature of the human beings. We, most of the time, tend to go too far. We, in a way, actually take things to their extreme. And we are doing the same in terms of the restructuring of the stock exchange or the capital markets business. Of course, I agree with you, Sandy, that competition is good. But, at the end of the day, why we established as human beings, as, economic units, something like stock exchange? Well, in order to have more transparency and price discovery. So if you fragment it at such an extreme that to such an extreme that at the end of the day it will not be possible to have neither transparency nor price discovery. So I think there is a very good proverb in French language, which is, and Roland, avec votre permission, chaque fois que le doigt montre la lune, les imbéciles toujours regardent le doigt. Am I correct? Every time that the finger points out the moon, the stupids always do look to the finger. And the competition is good for more efficiency. Competition is good for allocation economic resources in an appropriate way. But if at the end of the day competition works to the other way around, to kill the efficiency of the market. So what is the clue to continue in that direction? This is my open question. And as an academician, I like the questions more than the answers.
I took the message. Okay.
But I have a question. What does that French proverb saying have to do with fish? Fish.
Nothing. It's like bottom fishing or something like that?
No, I have to say your point is very well taken. The fact of the matter is, if you look at the U.S. markets, one of the areas, if you want to look at crisis, you have to look at the fact that if you run a stock exchange and you simply run a stock exchange that was an equity market, you're out of business because it's a rush to the bottom because of competition. In the United States, we have, you ready for this? Over 100 separate trading modalities. Over 100. If you aggregate the stock traded in equities on New York and NASDAQ, you get less than 50%. So competition is good, fragmentation's insane. And if you want to have markets that are solid, you can't have competition. Now, as I said before, you have competition even in a monopoly market because money goes everywhere. But when you add that, that's why you have New York, that's why you have NASDAQ, even the Deutsche Börse. Everyone's looking to global strategies because if you're simply going to run a stock market that does equities, forget it. It's just a horrible business with very few opportunities. And as for you not being a risk taker, if you were not a risk taker, you'd still be in the classroom.
Okay. Yeah, please.
Yes, but at the end of the day, everybody now is discussing about how to bring more, how to say, emerging markets into the global scene. And in order to have a more balanced, sustainable, and stronger growth, everybody says that we need emerging markets to kick in. But emerging markets depend heavily on small and medium-sized enterprises. And the only way for them to develop their business is to have access over financial markets and most of the time equity market. Because, bank lending is very scarce and for them it's very difficult to have access over it. So I think we still need a well-developed, efficiently, properly functioning equity markets. And this should be number one consideration for all of us.
Mr. Turhan, we are talking about the cooperation rather than competition right now. Do you think that there is a competition between the London Stock Exchange and Istanbul Stock Exchange, or cooperation will be there?
Now?
Yeah.
Well, both. There is a competition between exchanges. There is competition between organized and unorganized trading platform. There is a competition between unorganized platform, and there is a competition between the companies which are listed into one of or several of those trading venues. So it's a little bit complicated. It's like a solar system. Mm-hmm. The planet turns around itself, and at the same time turns around, make this circular movement around the star. And there are orbits, etc. So it's really complicated. But yes, there are competition at each level.
Okay, Mr. Godet.
Thank you. So I will try to answer to the questions that you asked me. All three questions are very related, so I'll try to be short on that. Tradable markets, OTC versus listed, and mark-to-market, is it good or bad? I think a very important point that was made previously was about the price discovery issue, and I think that's the only reason why at the end we are there. And the second one would be maybe counterparty risk. Obviously, we saw that in the 2008 and 2009 crisis that one of the major issues that were faced by investors was the fact that they were ending up with the possibility of not being paid with the OTC contracts that they had been contracting with some failing counterparties. Having said that, there are some markets that, for some reasons, not moving to the listed side. What comes to my mind is just the interest rate derivative swap market, which is one of the largest markets in the world. And all the attempts to have some kind of futures on swap index have been failing. On one side, you have massive bond futures indices that are used as hedge to the interest rate swap markets. Those markets that have been trying to launch on very popular maturities like 5-year or 10 years swap contracts have been failing. So for some reason, there are some markets that can function well without being listed. Having said that, I tend to think that, however, MiFID was also quoted, we need to have more transparency for investors in terms of best execution. And obviously, having products listed on market is the best way to ensure investors that there is transparency in the way the prices are constructed and disclosed. But you can still have this debate on whether all markets should be, all products should be listed. I think that in the case of products that are not listed, you need to ensure that you have a very, very strong regulation and very, very strong regulatory bodies that would make sure that there will be a disclosure of the positions on those assets, because otherwise it's going to, again, lead to some other crisis. Another idea that came to my mind is the story that happened to JP Morgan this year, with the fact that within JP Morgan, two desks dealing with the same instruments, complex instruments on credit derivatives, ended with different valuations. So they could even trade one versus the other and having the feeling that they were making or losing money within the house, which obviously is just a nonsense. So obviously you need more and more homogeneity and way to challenge the way prices are constructed, because otherwise you can end up with false results and abnormal position being constructed in institutions. Obviously it happened at JP Morgan, that is a massive bank with a lot of resources, but the same amount of losses occurring at a much smaller institution, the institution would have disappeared nowadays. So you can have a lot of debate on that, definitely. And mark-to-market, is it good or bad? I think it's not really the point. If you intend to sell the security you've been purchasing, let's say in a short time horizon, yes, you need to be in mark-to-market. There's no clue about that. But otherwise, though the mark-to-market may be available, if you intend to keep to maturity, for example, an asset, it's perfectly understandable that you would smooth or take the loss over time. And this is not really a problem of being listed or in exchange or not. It's a problem of accounting regulation and proper work conducted by regulatory bodies. So I think the conclusion of this is that you need to have a very fine functioning between, obviously, the financial institutions that create and book those products, obviously the way they disclose the risk and the way they are going to price these products to the clients. We all have in mind, obviously, all the trials that are underway in many countries where municipalities, for example, are challenging the way they've been sold and how some products have been revalued over time by some banks. We need to have also a very strong involvement of regulators, which also means that as for stock exchange, they have the appropriate level of technology and knowledge for those products to be able to challenge the banks. And you need to have the also appropriate accounting framework to make sure that those products are used in a nice way. Financial products are not bad, they're not evil. And when you read that in newspaper, I just don't get the point. It's obviously just the way they are used, they are monitored, they are followed, that can lead to very nasty situations. And obviously, we all want those situations to disappear. And in that context, definitely, having more products listed on exchanges is definitely a good thing.
As the last question, Mr. Rashed said that the demand is increasing very rapidly in the GCC countries, bonds and sukuk. Do you think that it's a good time to invest in European bonds or the GCC bonds?
Okay, I'm supposed to be a specialist of emerging markets, but I can give you some feedback on that. Is it a good time to invest in European government bonds? On peripheral bonds, maybe. On core countries, you're not going to make a lot of money. And most likely you are going to lose money if inflation moves higher than the yields that you get. So you may have risk constraints, reasons on risk that would push you to do that. That's why we've been having negative interest rates in Switzerland as far as to the 5-year maturity, which is amazing. Can you imagine for 5 years having a negative interest rate? But for risk constraints, this is the situation that we've been having recently. Similarly, we had negative interest rates in German two-year yield because people were needing to have this kind of security in the quality of the asset that they were buying to do something else, let's say. So flight to quality can distort definitely level of prices to levels where you're not going to make money. Peripheral countries, yes, if you think that the ECB will do what it stated since, let's say, the end of July, yes, you can buy short-term Spanish or Italian bond. there's a risk for that, but obviously you also get the remuneration for it, so you're paid for the risk. Having said that, something very interesting that was mentioned, yes, is the development of the emerging market fixed income products. And though emerging market equities have been disappointing both in terms of performances and flows over the past now 2 to 3 years, emerging market bond funds have been performing very well and have been attracting massive inflows. Yeah, you have both sides of the coins, and there is still room to make money in emerging market fixed income. Yeah.
Okay, thank you very much indeed. Mr. Gerstenschlager, I know that German people are very good at foreign affairs. And what about the impact of this European crisis in terms of your transaction volume of Deutsche Börse?
Yeah, of course. I mean, the financial crisis hit the volumes massively from the exchanges. This is true for all exchanges in Europe. It's true for all exchanges globally. But similar, what we look for it is two major impacts. Or let's say it's one impact. Investors are not confident anymore in the markets. That's number one. And investors have a portfolio and they don't change it now. They just don't trade it. They don't need to do hedges as well. They don't move it. They don't change it. They stay with the portfolio. So what we measure, for example, is the turnover on our DAX compared to the free float of all the capital of all these 30 stocks in the DAX. This is traditionally absolutely low at 0.8%. Usually it's at 1% or 1.2%. So it's the majority of the portfolio at our investors. It's a very, very low level. We think that it's not a structural issue. It's typically a cyclical issue of these crises at the moment. However, the second question was exactly cooperation on the exchanges. Crisis, financial crisis, yes or no, doesn't matter. There is a need for further cooperation of exchanges. The biggest problem of exchanges, they are all unique. Yeah, they are unique by national regulation, they're unique by tradition, they're unique by national processes for good reasons. But however, we have to get closer to harmonize a lot of things to be really able to open up for institutional investors, cross-border trades and other things. So we have to work together on that. It is over with the monopoly of having one market. It is, I totally agree, it's competition of market. If we like that or we don't, doesn't matter. It's no discussion anymore. There is a competition in the market, and the competition in the market, however, cooperation makes sense. Cooperation, we believe, is the cooperation has to work on a process level. So mean cooperation in settlement, cooperation in risk management features. So these are the typical cooperation issues we'll see. And coming to the crisis overall, this crisis in Germany in particular, or in Central Europe, is different than a lot of other financial crises we have seen in the last, I'm now 25 years in that business, because its major issue is, in Germany in particular, the real industry has no confidence anymore in the financial sector. This is absolutely new. So they don't trust the processes, so transparency will help that. For us, exchange providers will help that we could prove that we are part of the solution, that we are not part of the problem anymore in the future. However, we have to get more transparency in the market. It's not about bid and ask prices. It's about transparency of the rule book, transparency of the risk calculation, transparency of whatever volumes which have been traded in the dark so far. We have to recognize the industry want to see if a bubble coming up. The bubble will come up, but they want to see it earlier. That is really what they expect. In particular in Germany, we have a huge pressure from really what we call the real industry on the financial sector to change behavior. And that's exactly where the politicians now coming in, and they listen mainly to the real industry and say, we want to see more action from the financial industry to cover this new world in the future, and then regulators have to act. But in Europe it is, we need a European regulator. It will not help us if now our German regulators has a short selling ban, because 70% of the business traded on the Frankfurt Stock Exchange is coming from members abroad. So I don't need a German short selling ban. That's something complexity I don't need at all. Yeah? Same as financial transaction tax, same as high frequency trading. We need clear European regulations in the future.
As the last question, do you think that is there a correlation between the company values, I mean prices, and the inflation? rate?
The company trading prices?
Yeah, exactly.
No. I don't know. I have no statistics on that. But thinking what's really the value of the companies in Germany is really what kind of possibilities they have to further on doing deals with China. There is a question of export. It's a question of the US dollar to euro rate. That's just a complexity, inflation.
Exactly. What I'm trying to understand if the inflation rate in the European area will go up. What's the impact for the company prices? Trading prices?
My overall belief is that what I put on that slide, the equity market will come back. There are huge investors having a moment. Insurance companies in Germany, or pension funds in Germany have a very, very low equity exposure. I'm quite sure that they will increase their equity exposure. They need safe assets, and equity is volatile, yes. But they cannot spend all the money into real estate and commodities, and they have to get out of these fixed income products, so they will move to equities. So equity prices will go up if the uncertainty stays with the market.
Okay, thank you very much. Roland, would you like to comment this the same question? I asked this question because 2 months ago I had the chance to talk to Mr. Roger Meyerson, one of Nobel winner. He said that, I don't know of the United States, but for my calculations, in the European area, European Central Bank will print money to cause, roughly 10% of price inflation. And the potential growth rate of the European Union is 10% under its potential right now. For that reason, it's not good for me because I'm trying to save my retirement, but it's good for the companies, it's good for the countries or something like that.
I would say that, more or less the same answer as Frank. Longer term, if you have inflation, basically the fixed income products, which are fixed rate, will have to go down. So very clearly people will start investing in equities, and normally over the longer run, the price of the equities would include part of the inflation. But all this is like economic theory. At the end, you still have other variables impacting, including what's going on the individual company. So broadly, long-term, yes. Short-term, a lot of the exceptions to it. But I would like just to come back on one thing which was very important when you talk about exchange partnership and the role of an exchange, and you want to transform Istanbul as a financial center. Transforming a marketplace as a financial center is not only about privatizing, creating more freedom for people to invest, for foreigners to invest. It's more than that. It's proper regulation. And what's the meaning of proper regulation? It's not only about setting guidelines and that's it. You all know that in European markets and also in the US and everywhere, there's a competition between banking supervisors and security supervisors. And the whole shadow banking which is developed in Europe is the fact that those two types of supervisors never agreed between themselves. And if you look at the way the products are created, we're just mentioning OTC products, but also products are not bad by themselves. That's true. But you need to understand where the brokers and the banks are making money out of those products. I'll take an example, ETFs, traded funds. Everyone thought that it's good to regulate the ETFs. It's good to say that an ETF should reflect the assets underlying, or if they have synthetic ETFs, they should really follow certain rules and be explicit and inform the investor. And everyone was happy that this is enough as a regulation. Practically everyone was forgetting what's happening behind, how the banks are hedging, how the banks are using the collateral to lend the money, and what's going on in terms of systemic risk. So not understanding the products, you're just ending up in doing a regulation which is just about informing. And that's not proper regulation. So building a financial center, it's again privatizing, creating the right infrastructure, but equally understanding what are the key challenges. We have a trading exchange, you have securities, you have gold, you have commodities, you have the derivatives, and at the same time you have a clearinghouse with some banking functions. Look at what's going on across the world. You have in the US, DTCC, pure utility. Most of the banking functions are kept by the banks. A lot of added value over there. In Europe, it's slightly different, with a lot of competition in between the banks and the major custodians like Euroclear and Clearstream. So again, here, by setting up a financial center, you need to make a decision, political one, about which one do you want to protect, the investor, or do you want to have more of a banking system, or more of a system which is purely centralized on an exchange? All these are very key questions when you set up a financial center. And having the experience we have had, I mean, not the only ones, but to this, what happened in Europe and in the US, it's invaluable to set up the right infrastructure. I mean, we have, and the slide of Frank was also explicit, MiFID is a huge European regulation. Everyone is still arguing about MiFID 1, MiFID 2, but everyone forgets why this has been set up 10 years ago. The objective was quite simple. You get to one single financial market with one single currency. Objective is for companies, listed companies, to raise capital across a broader pool of liquidity, across all investors in Europe, having the same currency, able to invest in companies across all the markets, which ends up in having a lower cost of capital. Where are we today? It's a fragmented market, opacity, and just basically seen as MiFID as a tool to compete against exchanges. That's not the objective. Everyone forgot the initial objective. So setting up the right infrastructure, setting up a financial center, having a long-term view of where you want to be, and knowing where the added value is.
Well, I'll go to that question on financial centers. I had the opportunity in my life to have to not be strictly a child of one industry. I worked in government for many years, and I also worked in real estate development. So I had the opportunity to build the World Financial Center in New York when I was president of the Battery Park City Authority. And then I worked with Olympia in York when they built it. A financial center, to be a financial center, is a very legitimate and important aspiration. It isn't just buildings. It's a location where people want to come because they believe that A, it's an opportunity and it's a good place to trade. And the second is because it's a good place to live. And those two things come together, hand in glove. Now, I think I probably will get myself in a lot of trouble because there are a lot of people who support it or some people who don't. But the fact of the matter is that Istanbul is a wonderful location to have a financial center from a number of different vantage points. It has an educated population. It is a wonderful place to be, except if you're in a car in rush hour, which, by the way, stretches from 12 to 12. It is a wonderful blend of the past and of the future. It is importantly and centrally located between two worlds that if they don't come together, will kill each other. It's no accident that the World Federation of Exchanges reached out to a former head of the Istanbul Stock Exchange to run the World Federation of Exchanges, because the board, which you're on, Deutsche Börse is on, recognized that we wanted somebody who did not come from a very narrow perspective, but who could, in fact, have a global perspective and to help build the relationships between existing markets and emerging markets and between continents and maybe even between religions. So Istanbul should be a world financial center. Now, one of the criteria is that it has to have a futuristic market. Regulation and how you structure the regulation is critical because if it has too many roadblocks, it will fail. If it doesn't have sufficient safeguards, it will fail. It has to have product to trade. And it has to have relationships into the global world. The Istanbul Stock Exchange has been evolving into a 21st century exchange. I think, as I said in my opening remarks, the decision to consolidate under one umbrella both the equities and the derivatives is a very, very important step. The fact, however, is that it has to be creative in terms of developing new product. I mean, we at NASDAQ have learned, I would think New York, just watching their actions, they have learned you can't be a boutique. You have to be really a department store, really. You have to recognize the limitations of your own market and the strengths of your own market. There's great strengths and opportunities in this market, but it is a market that will be slow or slower than others in terms of bringing people to the point where companies want to be IPOs. So it has to open itself up to new and creative kinds of products like exchange-traded funds and indexes. IPO, capital formation, is a very important and definitive attribute or criteria to be a capital market. But let's remember, the capital formation on these markets is in the first millisecond after the IPO takes place. After that, it's trading. It's not capital formation. And that's where you get traders. The traders don't come for the IPO. The traders come for the post-IPO. So what you have is a need to be able to have a market that's dexterous, that can move quickly, that can incorporate new products, that can entice people to come here to trade, that not only have primary products like equities, but also have hedge products, that have derivative hedge products, and other kinds of products. It is the depth of the market, the opportunities that are created, but do not forget the regulatory side, the stability side, and the quality of life side.
Yes, sir.
Your question about the oil of the price of the oil with the bond. Of course, the oil is the backbone of almost everything. So it has an effect on the bond and bond issuance. So if I want to answer this question, it has many answers. But the way I look at it, when it comes to the government point of view, of course, when the price of the oil is high, they're not going to go ask for money. And as a matter of fact, the bond or sukuk market might slow down. And you could argue the opposite, by the way. When it comes to the private sectors, if the price of the oil goes up, that means more infrastructure, that means more investment, that means different investment in different places. So that means companies need money, and bond will be one of the good alternatives. And since we're talking about the bond and the government, one of the problems that we face in Abu Dhabi, the government does not want to borrow. So we don't have the dirham denominated bond.
What kind of government is that? That doesn't want to borrow.
Very rich government. So for the corporate bond, they cannot use a government bond as a benchmark. So this is one of the biggest challenge, and believe it or not, we've been trying to see a bond related to the government, I would say since 2004. And we still keep trying. And about the competition or competing with Istanbul Stock Exchange, I had a chance to look at the note, one of the notes in the booklets that I got from you, and I was surprised, or it got my attention when I compared the value traded of equity versus the bond. Correct me if I'm wrong, it was 178 versus $2 trillion. That's not to me, that's to everybody. It's an opportunity to learn from the successful story. I see it as a successful story. I see a very active bond market that exchanges like us should take advantage of. So it's not competing, it is trying to take advantage of that and trying to see how can we follow those steps and learn from the mistakes.
Mr. Turhan, actually, everybody's talking about the Istanbul as a financial center, and we've been trying to set up a cooperation between many stock exchanges. What is your aim? What are you trying to do?
Well, I just try to reflect the wisdom of the past into the business field of the future. Well, to elaborate a little bit on what my brother Rashed has just mentioned, because this was the very same question I was asked in Dubai last week. They asked me whether the Turkish corporations, Turkish business, Turkish stock exchange is a threat for the region or not. And I told, well, of course we are in competition. This is what Adam Smith mentioned some 200 years ago, said that, well, out of the selfish behavior of human beings, you will end up with a virtue at collective level, societal level. But there may be different kind of competitions. For example, I mean, every Turkish, everybody from Turkey in the room remembers it. There is a story about the two shopkeepers in Edirne. It was during the conquest of Istanbul that the church in Istanbul really had some worries, concerns, because everybody was aware that the Turks were trying to prepare a campaign for the Istanbul. And they sent two priests to Edirne to understand better what is taking place. And they directly go to the bazaar, because as you know, in bazaar you can have every piece of information. It's the price discovery field. So they entered into one of the shops in the morning, and in order to open up a discussion, a conversation, they tried to buy something. And the shopkeeper very politely said that, you are welcome, you are our guests, I can offer you some tea, some coffee, whatever you want. But please, could you kindly just go to the next shop, my neighbor? Because I have already sold something in the morning, because this is a tradition of us. In the morning, when you make the first sale, we call it siftah. And it is very, I'm sure, familiar to our brother Rashed. Siftah means the opening sale. So the mentality was that I have already sold something, but I need my neighbor to keep on making business as well, because this is a bazaar, this is a market, this is not only one shop. If there is only one shop, it will be very difficult. It will be maybe unsustainable for the shopkeeper himself. But if you have plenty of shops making all business within competition, but such kind of a competition that does not exclude the collaboration at the same time. A win-win situation, as you described. So, and the press really amazed, because the same happened when they went to the second shop. And the second shopkeeper drove them to the third one, and so on and so forth. So, if we can, as exchanges, develop such kind of a network, an ecosystem, this will be the only way of surviving, believe me. Because otherwise, it will be not possible to compete from the pressure, competitive pressure coming from unorganized markets. Because, for example, I know the situation in, let's say, in kayaks. And they are running a huge market with less than 20 people. And I mean, they have nothing. And even kayaks is, in a way, organized compared to some dark pools or some MTFs. Surrounding. So it will not be possible, and this is something very dangerous to me, because I mean it's earlier mentioned already. But you know, since the beginning of the crisis, I don't remember any single G20 or IFSB meeting. If I'm not, I'm wrong, please, Mr. Governor, correct me. Where the discussion was not about how to how to channel the unorganized markets, the products that is traded at unorganized markets towards exchanges, towards organized markets. This is number one agenda item in every single G20 IFSB meeting. But guess what? Since the startup of the crisis, the turnover, the volume in unorganized markets has increased by 40%. So we are risking ourselves, believe me, because God forbids, if something bad happens, it will be really disastrous because we cannot survive another series of troublesome or turbulent atmosphere. So we should develop an ecosystem for exchanges where everything will be open, will be ready to be shared. Everybody will make money. I do believe that there are plenty of opportunities, enough for everybody. So we can work together, we can walk together. And the very reason why I am trying to establish this kind of interlinkages between exchanges, this is number one. And the number two is that, as I already said, everybody is talking about emerging markets. And for the time being, the business model requires emerging markets, even in order to get a relation between themselves, to get through a mature market, an advanced economy. But whenever there is a problem in one of the advanced economies, the relation between emerging markets also suffers. And this is not good for the global output, global growth, global economy. So if we want emerging markets to play a more determining role in the making up of the global economy, we need to establish an intra-emerging markets network. And this is why I am really traveling so much.
Can I just say something about
as a closing
Ibrahim?
remark? Okay.
All right, well, as a closing remark, then, let me just say, I'm on the board of the World Federation of Exchanges. Ibrahim is as well. And I just want to say that he's been there for a relatively short period of time, but he's made a very significant impact. For example, I was in Rio with him, where he took a major lead at the Rio Plus 20 conference and helped drive a resolution through the board last week, or 2 weeks ago, at the World Federation of Exchanges, where sustainability should be an issue that stock exchanges deal with. The question of how that relates to reporting requirements is very, very important. But it's very, very important that we have the discussion and start to have the discussion. He helped drive that consideration. As I say, he helped drive the outcome of the direction in terms of the leadership, the management of the World Federation of Exchanges. He has quietly but effectively insisted that for the first time, the World Federation of Exchanges deals with the issue of emerging market, as opposed to simply be a sounding board for the larger markets like some of the rest of us. That doesn't mean that the existing markets won't have a significant role and have the advocacy that a world organization should have, but at least it should be in parallel with the issues of emergency markets. So not only internally have we seen the Istanbul Stock Exchange taking on a very forward-looking direction and having the exchange become part of a very significant part of the ecostructure, the financial ecostructure, with the recognition that capital markets have to be very central to the financial ecostructure of a country and a region. But also, he's pushing those issues on a global basis. What is the amount of effective kinds of disclosures that should be made? You can't have everything on a piece of paper demanding volumes and volumes and reams of wasted paper, but you should have the relevant information. He was pushing, and I recall, that the WFE has to take on governance issues and become a model, because governance is central to what stock exchanges have to insist on in terms of what listed companies are about. So these directions not only are happening here, and I hate to flatter him because you know how he gets, but the truth of the matter is, in a relative period of time, he's become a very, very important and driving player on the global scene of world markets.
Okay. Thank you, Sandy. Mr. Rashed, as a closing remark, one sentence, if you would like to tell.
during this crisis, there are opportunities where each exchange has to take advantage of. And I think all what we need to do just to dig into ourselves and see what can we do to our exchanges. And I think we could do or we could have a different look for our exchanges.
Okay, thank you. Roland?
Just a comment on, we have been debating a lot about the risk and the opportunities, but at the end of the day, we should never forget that an exchange has two functions, raising capital, and again, raising capital is, we should revert back to what's the meaning of raising capital. I mean, today, exchanges, for most of them, are just writing down the name of the company on the blackboard. They don't really help raising capital. Raising capital is about allocating shares in a very efficient way, equally, with a lot of equality across all the investors. And this is something which has been more or less gradually forgotten. So never forget the two roles of exchanges, raising capital and secondary trading in this sequence. Just to make sure that at the end of the day, the fundamental of the capitalism is still there.
Okay, thank you very much indeed. Frank?
Yeah, I mean, just one word, the difference between developed market and emerging market, I mean, we have pretty much the same similar task. Yeah? In the future, will be questions how we are able to support our real industry by financing the future. And that's typically for small enterprises in Germany pretty much the same as it might be here in Turkey. And of course, we have found a solution that is our core objective in the future, really to finance the industry for further growth. That is important for the society.
Okay. Monsieur?
Yeah, I think we are all impressed by the development of Turkey over the past, let's say, 10 to 15 years. Turkish financial institutions have become references in the way banks should be managed overall. They are doing very, very well, and they are attracting investments from everywhere in the world, from developed countries, but also from emerging countries. I think there is a challenge there for the exchange to become a similar reference in the world of exchanges as Turkish banks have become among emerging markets and even more broadly banks in the world.
Dear panelists, thanks for your contribution and thank you very much indeed. Thanks for joining us.
We'd like to thank the distinguished members of the panel. Konuşmacılarımıza teşekkür ettikten sonra sizleri kısa bir kahve molasına davet ediyoruz. Ardından saat 16.15'te Keynote tartışma platformuyla tekrar İstanbul Finans Zirvesi devam edecek.